All right, folks, we will get started. Welcome, good afternoon, to the Smart Money webinar series. My name is Josh Strittmatter. I'd like to thank you for joining us today. Our presentation today is titled Budgeting in Retirement. For those of you that don't know us, we are Strittmatter Wealth Management Group, a registered independent advisor. Give me one second. There we go. Located in Fort Worth, Texas. Actually, in our new location, we just moved right off of Montgomery in Fort Worth. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in, and we will be happy to answer those for you. Also, we will be sending out a replay of today's webinar via email, so if you missed something, don't panic. You'll have the ability to watch this again, and you are welcome to forward this presentation and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely financial education and not advice, so please talk to your licensed professional before taking action on any information today. And for more information, including key disclosures, please visit our website at strittmatterwealth.com. Now I want to introduce myself. So a little bit of information about me. I am from Fort Worth, went to school at UTA in Arlington, have a degree in finance. I'm a certified financial planner as well as a certified retirement counselor, a member of the Financial Planning Association and CEO Network. Personally, I'm married with 3 daughters. We live out in Weatherford, and let's see. I love to help our clients with financial planning, investment management, and business planning, among many other things. So that's a little bit about me. All right, folks, let's jump on into our topic today, which is budgeting in retirement. Planning ahead is the key word, or the key phrase here. When you are planning for retirement, or even if you're in retirement, planning for future years is very important. And a big part of retirement planning is budgeting for retirement. And so everybody spends money differently. There's no two people that spend money the same way. So budgeting is different for different people. But there are the same components to budgeting for everyone. And that is to, first of all, define your needs, wants, and wishes. So where you're going to spend your money, in other words. And needs are your mandatory expenses. So expenses that will have to be paid, things like your mortgage, transportation, clothing, medical, insurance costs, things like that. Those are expenses that you want to document. And so when you're preparing your budget, folks, you can do this on a sheet of paper. You can do this on an Excel spreadsheet. We have an organizer, if you'd like one that's more organized, that has categories. I think you can even Google cash flow or a cash flow worksheet in Google, and it'll come up with a spreadsheet for you that's already categorized, or even a budgeting worksheet. But you want to start off with your mandatory expenses, and then you can calculate that on an annual basis and then divide by 12, or you can just look at it on a monthly basis. So starting off with your needs, then you would look at your discretionary expenses. These are the expenses that you would like to spend money on. And these are the extra expenses. So things like travel, activities, child's weddings, car, spoiling the grandkids, which a lot of people love to do. So really determining what your budget is for these expenses in advance is going to help you to plan for the future. And again, that budgeting worksheet will help you to do so. Once you've written down or typed in all of your expenses, then you want to consider your income sources. So different income sources that you'll have in retirement would be Social Security, pensions, if that's available to you, and then investments distributing income to you. So living off of your investments. And so you want to determine what your defined income is going to be. So again, those pensions, those Social Security income, and then define the gap. The gap is what will be the difference between your total expenses and your total income. And the gap is what you're going to have to replace with your investments. So when you're creating your budget, it's important to be realistic. You want to not be too overly conservative to where you won't enjoy life, but you also don't want to be overly aggressive with your budget to where you could run out of money. So you have to find that mix that's right for you and right for your future for your entire retirement. So keep in mind that while we may say that we can eat off of $20 a week, that's unrealistic. Especially with inflation in the last few years, costs have gone up substantially. So be sure and factor in inflation in your budget as you're looking at your overall expenses. So it's good to look at your spending list and to do a check-in from time to time and really determine where you're spending money. And that means looking at receipts, looking at different statements to just see what you think is what's reality. A lot of times people, what their perception is and isn't often reality. So bringing those two together is exactly what a budget does for you. And that just means, putting that pen to paper or creating your worksheet and pulling in the data from different sources. So if you use a credit card, it's analyzing that statement, looking at your checking account statements to see where you're spending money. Again, looking at all the essentials that you're spending money on and categorizing those. Keeping in mind when you're budgeting that the budget busters, as we call them, are the one-time purchases typically. So things like new cars, replacing roof. If you've paid off your mortgage, it's the property taxes and the insurance. It's gifts or holiday gifts like Christmas. These things can really blow up a budget. So you want to be sure and account for those in your monthly budget. And I'll show you a methodology here in just a moment to help you do that. And then remember that your living expenses will change over time. And a lot of people consider or think that, that living expenses will go down. And typically when they are talking about living expenses going down in retirement, let's see here. There we go. They often talk about reducing expenses by 20% down to 80% of what you were living off of when you were working. And what that's taking into account is the amount of money that you were saving to your 401k as an example, and then also FICA taxes, which is 7.65% of your pay. Those typically are around 20%, and that's why they say that your living expenses go down. Now, you may have other expenses that will change, but oftentimes they get replaced with something else. So when you have a lot of time on your hands, you tend to spend money on things that you enjoy doing, which is natural. So you may be spending the same amount of money, but it's just in different places once you're retired. And again, the idea of budgeting is just making sure that you're better prepared for retirement. It helps you feel like you have control over your situation, reduces anxiety, and helps you to sleep at night when you know that you're spending within your constraints. And so reviewing that budget on an ongoing basis is important. Making sure you have a process in place for how you're going to budget in future years is going to be key. And when we look at budgeting, there are 9 categories that I recommend that you start looking at for your retirement budget. The first category is your housing expenses. So will you have a mortgage or will your mortgage be paid off? You want to take into account property taxes, homeowners insurance. Remember, these are inflating at a pretty high rate right now. Everybody got a big surprise in the last couple of years with property taxes and with homeowners insurance going up substantially. So just keep in mind that you have to factor in inflation for future years as well. Home maintenance is a big one. And this really doesn't change throughout your life, but it's, again, is in retirement, you still have to replace dishwashers. So just making sure that you're prepared to replace appliances, a lot of these expenses that come up for your home that, may not happen every year, but may happen every 5 to 10 years is something to just keep in mind as you're creating your budget. And then lawn care, that's another big one. So if you're going to continue to take care of your lawn, might want to budget for a time that you can't take care of it anymore, or even your household chores. So considering what you're going to do in the future when you're no longer able to take care of those expenses. A lot of people think about downsizing, and we'll talk more about that in just a minute. Third area is health insurance. This is one of the major expenses these days. So, if you're preparing to retirement before the age of 65, you're going to have to look at outside insurance if you're not able to take your health insurance from your employer with you. So getting in touch with a good insurance agent who can help you to compare costs, compare different policies will be key. And then once you are on Medicare, that's where you want to just review all of your different Medicare options. So you have lots of different plans out there. We've got some experts that we refer to that if you'd like more help with that, we can refer you to them. But definitely that's a major cost for you. And, especially if you're coming from a big corporation where the cost of insurance is very low, it's very expensive these days if you're not used to that. So those are things to keep in mind when you're thinking about your health costs. Another big expense is long-term care. So long-term care affects 70% of the population if they live to age 65 or older. So something to definitely plan for in the future for yourself. Now, things we talk about with clients are long-term care insurance is a way to transfer risk to an insurance company, but the cost of insurance has gone up in the last few years. So we also look at the likelihood or the probability of more long-term illnesses like dementia that could suck away funds very quickly over a long period of time. So looking at your family history will be key to looking at how you're going to address long-term care. A lot of people want to self-insure, meaning they want to carve out assets for long-term care. And that's fine. You just need to make sure that you have enough assets to do so because the cost of long-term care is so expensive these days. The cost in Texas is right around $80,000 per year per person. And the challenge is if you're a married couple and one of you is living off of or has living expenses at your home, but then you add an additional $80,000 to that per year, that can be quite expensive, and that can zip through your assets very quickly. So making sure you have a plan for long-term care is very important, and budgeting in expenses in the future will be important. By the way, as we go through here and you have questions, feel free to ask them. So general living expenses. So again, food, utilities, cell phone, internet, gas, car, maintenance. These are everyday expenses that you have. Obviously, this will be taken into account with your budget. And again, just remember that those will inflate over time. So be sure and be realistic with those numbers. If you go to Starbucks, look at your Starbucks bill because it adds up. and my family, Starbucks and Chick-fil-A. So those are the two budget busters right there. Vacations. So a lot of people want to travel in retirement, and they want to make sure that they have money set aside for that. So making sure that you factored in the amount of money that you want to spend in retirement travel. And often people will increase that substantially because they want to go do things that they've never done before, go to, do international travel. And so just keeping in mind that can be a substantial amount these days. If you haven't traveled in a while, it's very expensive to travel these days. So 10,000 is typically where we tell people, a married couple, kind of a starting value if you want to do international travel per year. And then the question is how long do you budget for that? And oftentimes we tell people early 80s is typically when people slow down for travel. But definitely making sure that you've got money set aside. I'll also give you a tip here as an aside is that a lot of people wait to travel in retirement to do some of those big trips. I always recommend people don't do that because you don't know what's going to happen in life that would prevent you from being able to travel, like an illness, long-term care need, or even a family member that you have to take care of. So making sure that you do the things that you wanted to do while you're able is very important. And then there's typically just a window of time that you have to do that before you're able to do that. So I recommend if you haven't made your travel plans to do it right away and then start those travel plans as soon as you can instead of waiting until you're fully retired or until you're older, if that makes sense. Hobbies can be expensive. I play golf on occasion and it's very expensive. So you want to make sure that you've budgeted for your expensive hobbies. And, a lot of people, as they're going into retirement, depending on the amount of money that they have, they'll consider less expensive hobbies. And so just depending on what your goals and objectives are for retirement, there's lots of things that you can do in retirement, lots of fun things you can do. A lot of people volunteer and there's no cost other than time for volunteering, but hobbies can get expensive, so be sure and budget for those. And remember that you're going to have to buy new cars. And remember that you're going to be here a while. So we always have clients that say, well, I'm going to buy one more car when they're 65. And I highly doubt that. So, you want to consider that you may be driving well into your 80s. So you might need two cars. But saving for cars is important, or having money set aside in your investments is important for your cars. And just remembering that, cars cost have gone up substantially over the years. And oftentimes people do downsize to one car with families. So that's also something to consider. You don't typically need two cars if neither one of you are going to work, but definitely want to have that budget. And we have a strategy for car purchases that I'll show you in just a minute. And again is, making sure you have short-term reserves for those unexpected expenses, cash reserve, as it's also called, emergency reserve, making sure that you have money set aside for you that you can pull from when you need to. We typically recommend anywhere from $10,000 to $20,000 as a good cash reserve for retirees, just to have that ready cash available to you. So those are 9 categories to consider as you're building out your budget. And then I want to now show you our cash management strategy. This is a strategy that I've taught for 20 years, and it's probably one of the most valuable tools that we teach, because it significantly helps people. And there's the way to think about this is a tool that you can use before retirement and then after retirement in different ways, depending on you. So many of you probably have a budgeting technique that you use now that works for you, and that's fantastic. Keep using it. But if you want an alternative strategy that really works very well and is very simple, then I would recommend taking a look at this cash management strategy. So the benefits of the cash management strategy are that you can capture future pay increases and bonuses that can be invested towards your goals, and I'll explain that in just a moment. You can manage uneven cash flow, so getting paid on unexpected dates, having expenses that come up that throughout the month that you aren't expecting. Manage timing and expenses to more easily budget and track, and then give yourself a pay raise when you need it instead of when you get it. And again, this will all make sense in just a minute. And I'm going to skip forward to my chart, and then I'll show you the instructions, because this will be easier to look at on the chart here. So this is the cash management strategy, and hopefully all of you can see that. I'm going to explain this to you and the why behind it, and then I'll go back and give you the instructions on how to set it up. So the first step is how you pay yourself. Now, this is more in line with people who are still working. So if you're still working, what I'm about to show you is a very effective tool to help you save a lot of money, but also to help you to budget as well. And what it involves is where you send the money that you're making. So most people, when they get paid, they will send money, they'll direct deposit to their checking account that they pay their bills out of. This is different. This is splitting that between 2 different accounts. One is called the accumulation account. So this checking account number 1. The second is checking account number 2, the bill pay account. So what happens is you take all of your income and you deposit it into the checking account number 1, the accumulation account. Then on the first of the month, you transfer over 1 month's worth of your expenses. So this implies that you've tallied up all your expenses, you know what that number is, and you're going to transfer via auto transfer. So you're going to go into your bank and you're going to have it automatically transfer to the bill pay account every month on the same day. So you're not involved in it, it's just transferring on the same day. And then from there, you'll pay your bills out of the bill pay account. And you'll say, Josh, what is the purpose of that? Well, the purpose of that is that it locks in your lifestyle. So what happens is people make money throughout their working years. They get raises, they get bonuses, they get overtime pay. And that money just goes into their general bill pay account and typically gets spent and they don't even know how they spent it. So what the accumulation account serves as is a buffer. All the money comes in, but one amount comes out every month, and that's the same amount. So if I'll just use an easy number. Let's say $5,000 is the monthly amount. So I have 5,000 that transfers in from, well, I should say I get paid $5,000 a month. 5,000 goes into the accumulation account, and then on the first of the month, 5,000 transfers to the bill pay account. But now let's say that I get a pay raise to $5,100 per month. So $5,100 comes in, 5,000 transfers, $100 stays in that account and accumulates over time. Also, many people get paid 26 times a year. So that's 2 extra paychecks. If you get paid 52 times a year, that's 4 extra paychecks. So those extra paychecks also get captured in this account and accumulate. So what you'll find is, and I've heard this for many years now, people will say, Josh, we saved thousands of dollars. We don't know how we did it, but it was by using that accumulation account. It's an amazing tool. The other thing I will say about that is if you have kids, I would teach them that methodology because it's a very powerful tool for them as well to help them to identify how much money they spend, keep a budget, and then help them to save future dollars. So that's the accumulation account. The second part of it is how you pay your bills. And when I used to teach this a long time ago, nobody was using online bill pay, but now everybody uses it. So this is not a foreign idea anymore, but hopefully most of you are using your bank's online bill pay to pay your bills. So what this involves is setting up all of your vendors in your online bill pay feature at your bank, and then setting up recurring payments to the vendors. And I say the third of the month, but at the beginning of the month. It doesn't really matter what the day of the month is, just so that it's at the beginning of the month. And you'd say, Josh, well, some of those bills vary, right? Well, you can do a couple things. You can have them drafted out of the checking account, and that way that will resolve that, but just have them drafted at the beginning of the month, say on the 3rd. Or you can just overpay the bill and make an adjustment in future months, which is what I've done for many years. Because the bill doesn't often vary a ton. The other thing is if you have like a credit card bill that you're going in and paying, you would go in and just enter that in manually because that can vary substantially. So paying all your bills at the beginning of the month means what's left over is what I can spend for the remainder of the month as discretionary spending. So I take care of all my mandatory expenses at the beginning, and then what's left over is my discretionary spending. So with that number, I can plan out the rest of my month in terms of what I want to do for fun. Beyond that, what I would say is that a lot of people get bills throughout the month at different time frames. So what you can do is call those vendors and ask them to change the billing date for you. Most vendors will be happy to comply with that. That way you know what the amount is going to be by the beginning of the month. So that's one challenge you may have to overcome. But again, the whole purpose of this is to get all your mandatory expenses taken out at the beginning, and then what's left over is what you're going to live off of. Hopefully that makes sense. And again, feel free to ask any questions that you have, folks. The next part is how you allocate these funds that you receive. And it's looking at how you save money and treating savings as a bill. But it's also cash flowing those, especially in retirement. You want to make sure that you have cash flow set aside, that you can have the money set aside to be able to pay the bills when they come due. It's also a budgeting technique as well. So I'm going to explain this to you now. Notice the arrows coming down. And so with some of these arrows go back up. And so we'll start off with the emergency reserve. And this is simply a savings account. So a savings account an emergency reserve account is for unexpected expenses. So things like illnesses, home or car repairs, things that, again, you're just unexpected. This is something that you still want to maintain in retirement. Before you're retired, it's good to keep anywhere from 3 to 6 months of your expenses as an emergency reserve. But once you're retired, you really don't need to do that because most people are past the age of 59 and a half where they can access their qualified funds without paying a penalty. So when that happens, it all becomes one big bucket of money. And so from that standpoint, what we tell clients is 10 to 20,000 is a good emergency reserve to keep. That way you can put the rest of your money to work and earn as much interest or earnings as you can with it. In addition to that, what I recommend is because emergencies come up every month, I'm always tapping my emergency reserve, folks, is that you want to save monthly to it. So treat it like a bill. And depending on what your goal is, that would determine the amount that you save. But I always say at a minimum, save about $100 a month if you can to your emergency reserve. And what that serves is to replenish the account as you take money out of it systematically or automatically. So you're always replenishing it and then you're taking it out as needed. When the emergency comes up, you simply transfer it back to the bill pay account. And then again, you're transferring monthly on the 3rd via auto transfer so that you're not having to do it yourself manually to that emergency reserve. The second account is also a savings account. We call it the expense account. This is for expected expenses. So property taxes, insurance, if you don't escrow, you'd want to save monthly for those expenses. Travel is the other big thing as well, gifts. So budget busters, as we call them, things that don't happen monthly, but maybe once or twice a year, you want to save to this account to save for that. So you take out how much you want to spend in those different areas, and you divide that number by 12, and you do an auto transfer on the 3rd into this account. Then when those expenses come due, you just transfer it right back up to the bill pay account and you pay that expense. The third account is the savings account. And it's called a car fund account. So the car fund account is fantastic because it helps you to save money and pay cash for cars. The car industry has done a fantastic job of making people think about a car as a payment and not as a total amount of money. And so you can afford this car because you can afford this payment. Well, what I want to know is, what is the price of the car? What am I paying for this car? And what I have found over the years is I'm much more likely to write a check for a smaller amount of a car than I am a bigger amount of car because I'm pretty frugal. But that doesn't mean you can't buy expensive cars. It just means that what this allows you to do is save the money to the account and pay cash for that car. And so as an example, if you want to buy a $60,000 car and you want to do that over 10 years, that's $6,000 a year. $500 a month is what you would need to save to that account to save that up for yourself. So that's a very effective methodology for helping you avoiding paying interest on car payments, and then thinking more about the price that you're paying for the car. Again, this is not necessarily for everybody. You may have funds set aside with your investments that we're paying for your cars for, and that works just fine too. This is really meant for, I think, people who need to save monthly for a car just to make sure it's part of their overall budget. The next part is the budgeting piece, the simplified budgeting piece. So this is looking at how you spend money on a week or day-to-day basis, I should say. And so I came up with this idea a long time ago for my wife and I, because one of us is a spendthrift. I won't tell you who. One of us is a saver. So when we had a monthly budget, it was very easy to go past that monthly budget. So we needed a methodology for how to not go and bust the budget. So what we did is we came up with this idea of where we transfer weekly to an allowance account. We each have our own allowance account, and we save weekly, so it funds on Monday. And what will happen is that's their weekly, or that's my wife's weekly allotment for eating out, groceries, clothing, different things that my wife spends money on, different things that I spend money on. So I usually pay for us when we go out to eat. She usually buys the groceries, as an example. So different amounts for both of us. We don't get the same amount of money. And the beauty of this, folks, is that, again, if we had spent through that budget within that week, actually, let me take a step back. If we'd spent through that before the month end, if I had just transferred that in for the month, and 2 weeks into it, we're out of money, we're out of luck, right? But it's much easier to manage if I'm out of money by Friday. All I got to do is wait till Monday. In fact, that's a famous saying in my house is we got to wait till Monday because that's when the accounts fund again for our weekly allotment for our budget. So super simplified. It's an auto transfer. And that means what that implies is we're carrying around debit cards. Debit card works just like a credit card. You can use it as a debit card or a credit card. You don't have to type in a PIN. You can choose the credit option. And again, you're not keeping a lot of money in there anyway. So people always talk about security. Well, you're not putting a ton of money in that account for the people to steal. So very effective method. I've used it for many years. Clients say they've loved it. Something to consider in retirement too, because it helps you to keep your weekly budget. That brings me to credit cards. So credit cards are budget busters, folks. And so the problem with credit cards is there is no cap typically on what you can spend, or it's a very large cap. And so people will always say to me, Josh, but we pay them off at the end of every month. Well, that's fantastic while you're working. But when you're retired, well, first of all, if you're working and you overspend on a credit card, you can just work longer. You can get overtime. You can take the bonuses that you earn at the end of the year and pay off that credit card, right? But in retirement, there is no overtime. There's no bonuses paid to you. So you've got to pull from your investments when you overspend. And what that means is that you are reducing from your base amount that you're paying yourself from. And that can have a substantial effect on the longevity of your portfolio. So you don't want to go over your budget in retirement if you can avoid that. And again, a credit card is an easy way to do that if you're not disciplined. So if you're disciplined and you're within your budget, fantastic. I think it's a great way to make it easy on yourself. But if you don't feel like you have that discipline, I recommend using the allowance accounts and then only using your credit card for recurring expenses, things like your phone bill, your Netflix, things that, again, are going to be charged no matter what, so you can earn the points that you want to earn. So remember, your budget is more important than the points. Points are nice, but they're not. They're not as important as making sure you don't run out of money. So you be the judge for yourself on how you set up your budget, your weekly budget. But that's one that we recommend to use the debit cards. Lastly is the fuel card. So the fuel card is what we've used in my family. We actually, sorry about that. Let me go back up here. The fuel card is what we use because it's difficult to budget for gas in my family. So as I mentioned, married with 3 daughters, what we actually did is set up a fleet card. So the credit card company doesn't know that if you're a company or if you're an individual, they don't really care. But for us, we set up a fleet card, and so each of my family members has a fleet card. What's unique about that and different from a credit card is I can set it up to where they can't spend it on anything but fuel. So if I gave my daughters a credit card, they'd probably jump for joy and give me a kiss. But the fuel card limits their ability to use that card just for gas. So again, the fuel card is an easy tool to make sure that we're not overspending by using that card for something other than fuel. But also I don't have to include it in my allowance account because it's so unpredictable with gas prices and then depending on where I'm going each day. So that is the cash management strategy. Hopefully you have found that valuable. Let me now go back a bit here and I'll tell you how to set it up. And one of the common questions that comes up for this, folks, is, do you really have that many bank accounts? And I tell people, yes, because the bank doesn't care how many bank accounts that you have. Now, and by the way, there are still free accounts available to you. They call them the college accounts. You don't have to open the account that you're charged a monthly fee for. However, that may be changing because of regulation that banks are going to have to start charging fees because they're not able to charge fees in other places. So just, check with your bank, explore other banks if you want to. Credit union, I've banked at a credit union for many years and there's no fees on my accounts there. But yeah, the premise of this is that the separation of accounts is how you're able to effectively manage all of this different monies that you're transferring. So setting this up, if you're going to use the accumulation account, you'd want to change the direct deposit from your job and then from other sources. Like if you're going to do this with Social Security or with pensions, you change your direct deposit to go to the accumulation account. You need to know what 1 month of your expenses is so that you can set up your auto transfer from the accumulation account to the bill pay account. So you need to make sure you look at your budget first. If you need help with that, let us know. And then the auto transfer is simply set up through your bank, and you can do that on your own, or you can ask the bank to assist you. Another key point is bullet point number 3 here is set up your accumulation account as your overdraft protection. Sometimes you may overspend in your bill pay account and you don't want to be charged fees if you can avoid it. So having the accumulation account set up as overdraft protection will help that. And again, set up the automatic transfer for the first of the month from the accumulation account to your bill pay account. Enter in all your bills in the online bill pay feature of your bank and set them up to be paid at the beginning of the month. Again, you may need to request a change in the bill date. And then just need to monitor it. So remember, this is a new system for you. It's not going to be perfect. You're going to have to monitor it and increase or decrease transfers as necessary. Don't get frustrated. Just roll with it. And over time, it will begin to work without you participating in it. So it becomes automatic, which is the whole idea behind this. The one-time expense account, again, is for expected expenses. And these are things like vacation, holidays, insurances, and property taxes. So you want to calculate the annual amounts for all of those that you're budgeting for, and then just divide that by 12, and you'll set up an auto transfer to that bill pay account. From the bill pay account to the one-time expense account. By the way, in your bank, you can label your accounts. You can title them with these different titles. That makes it much easier to follow when you go in and change the name of the account. And then again, is when you have the expenses come up, just transfer that money back. We talked about the gas card. So again, that's a great way to help you to budget without using a credit card. Paying for groceries. You can use cash. You can set up automatic transfers to the debit account. A lot of people still like cash. So this methodology can be used with cash. You just have to go back to the old envelope system, as it's called, where you're putting cash into the different categories. Remember, it's important to have fun, folks. Life is short. You want to enjoy yourself, but you want to do it responsibly. So make sure you have play money set aside for yourself. Make sure you plan your play. So one of the key things that I teach is that life gets really busy. And if you're not careful, it'll pass you by and you would have done nothing fun. So plan your travel, plan your vacations well in advance. If you need help, if you're not a planner, use a travel planner. They're fantastic to help you to plan your vacations for yourself and to help you to stay within your budget. But also plan your family events, plan for how much those are going to cost. So that will help you to stay on budget and to enjoy life overall. There again is that strategy. We'll send out the replay so you can look at this and study it if you want to. All right, folks. So hopefully you enjoyed that presentation for retirement budgeting. If you have any questions, feel free to just give us a call, shoot us an email. We'll be happy to answer your questions. If you need an organizer to help you to gather your information and prepare your budget, we have one. If you don't already subscribe to our e-newsletters, you can go to strittmatterwealth.com, and we have some fantastic e-newsletters on a weekly market update, as well as a retirement newsletter. And then we've got our monthly webinar series, this webinar series. We're going to be teaching classes. They start up next. Actually, they've started. So we're at TCC Northeast this week, but we'll be at UTA and Tarleton for the remainder of the year for our estate planning class, very popular class. If you'd like to come learn more about estate planning, it's a 3-hour class on a Friday from 1 to 4. You can go to our website to sign up, and we'd love to see you there. And if you'd like to schedule a meeting, here's a QR code that you can simply just select with your phone, and that'll take you directly to the scheduling link. You can also, on the website, you can also schedule a meeting as well on our website. Due to technology, things are fantastic. All right, folks, so I'm going to take just a few minutes to answer any questions on the chat, so feel free to type those in for yourselves. Hope you've enjoyed it. Hope to see you in our next one next month. You'll have a fantastic rest of your day. Again, I'm going to stick around for anybody that has questions. Thank you.